Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And today we're going to take a look at the Great 15. So this is the third version of this type of video. First, I believe it was the Great 8, the Great 10, and now it's the Great 15 because of all the new amazing income-oriented cover call ETFs that are coming out in Canada. So this episode is going to focus on the Canadian market only. For you Americans watching, there's just so many on the US market that I can't do a great whatever, but I'm going to do other episodes called covered call ETF battles. We'll do one on the S&P, one on the NASDAQ, etc., etc. So stay tuned for those episodes. I know I've been saying it a long time, but I just have so much content to do. So in this episode, we're going to focus on the Great 15 in Canada. So let me go through the criteria first because it's very, very important. All right, so criteria number one is that all these 15 have to be or are sector diversified. They are diversified. So please don't tell me, well, what about Bank from Evolve or QQQY from Evolve? The first criteria is that these are all sector diversified. Number two, they use covered calls as the primary income strategy. There's one exception to that. But they're primarily income oriented and the primary strategy is covered call strategy. They all have leverage. So they all have a light, modest amount of leverage to really boost the income. But not only that, also to offset the yield, the total return drag that covered calls has on a quality asset for the long term, right? We know that doing cover calls on a quality asset that goes up over time will give you less total return because you're giving up a portion of the upside. So in Canada, we have these lightly leveraged cover call ETFs, if you will, to try to narrow that gap. So that's another criteria. All of them have leverage. It's light leverage. It's leverage integrated within the ETF. It's not you borrowing the money. It's the ETF manager doing it. And it's leverage that you don't really have to worry about holding for long term. In my opinion, yes, it's going to give you a little bit more volatility, but over the long term, it's going to help you in terms of total returns. So the main premise behind these 15 guys is that these are, in my opinion, this is not financial advice. This is my personal opinion. I think these are probably the 15 top income-oriented high-yield ETFs in Canada if you want to be an income investor to consider as a core or foundational position. Okay, I repeat, as a core or foundational position. So the ones you choose to include in your portfolio, the percentage, it's really up to you. But what I'm going to do in this video, now that we've gone through the criteria, is go through all 15 of them. And then I'm going to give you my opinion on what I feel for each of the 15, what I think should be the benchmark or what you could compare it to. We'll group them as well. I'll give you my opinion. Obviously, you know which ones I like the most because they're the ones I hold in my personal portfolio. But again, it's up to you to decide which ones to include in your portfolio. So let's get to it. All right, everyone, let's start with Great 15 number one. It's HYLD from Hamilton ETF. So this has been mentioned many, many times and talked about on the channel. I own this one myself, so do a lot of my family members as well. So this is the Hamilton Enhanced US Covered Call ETF. The best way I think about this is kind of like, I'm doing quotes here, an S&P 500, a concentrated S&P 500, if you will. There is a tiny, tiny, tiny bit in Canada in terms of those gold producers, right? So if you look at the holdings, you have them here. This is Hamilton's all-in-one ETF that focuses on the US market, almost $1 billion AUM, 0% management fee. It's subject to the management fee of the underlying ETFs, which means you're basically paying 0.65% management fee because most, if not all of these have 0.65% management fee. So SMAX and QMAX are the two biggest positions. SMAX gives you 20 or 25 the most important companies on the S&P 500. QMAX focuses on technology. You have some financials, etc., etc., etc. There is a little bit of gold producers in here as well, some real estate as well. So you see the mix here is very, very, very similar to the S&P 500. So this is really why I look at this as an S&P 500 or concentrated S&P 500, if you will. But take note that it is hedged to the Canadian dollar. It is hedged to the Canadian dollar. So this one I always compare to VSP as a benchmark, the Vanguard S&P 500 hedged to the Canadian dollar, right? So this is really, really good stuff here. I mean, the yield typically is between 12 and 13%. And very, very important note, two very important notes. One, remember that HYLD has changed dramatically at the beginning of 2024. That's when I call, or when I say HYLD became HYLD 2.0, that's when they kicked out all the third-party ETFs like QYLD and RYLD and a whole bunch of other crappier ETFs, and they went all in-house. So when I do the total return comparisons, and I, for example, versus VSP, which I think is what you should compare it to, I always start at the beginning of 2024. You might think that's cheating. I don't really care what you think, but that is really when HYLD became the HYLD that we know today. And right now, as of January 1st, 2024 versus the Vanguard S&P 500 in Canada, hedged to the Canadian dollar, HYLD is outperforming VFV. With dividends reinvested, with dividends not reinvested, just slightly under. So very, very good performance. So my opinion, everyone, when you think HYLD, think S&P 500 hedged the Canadian dollar. And don't forget, there's HYLD.U. So if you have USD currency, you don't want to deal with a 15% withholding tax in your TFSA and your cash account. HYLD.U is a great option. You could buy and sell it in USD currency, get your dividend in USD, but remember HYLD.U is still listed on the Canadian stock market, so there's no 15% withholding tax. Leverage 25%, monthly distributions since HYLD 2.0 came into effect at the beginning of 2024. There has been, right around here, there has been no dividend decreases, only increases, and they recently raised it from 14.5 cents to 14.7 cents. So you're looking at about 12 to 13.5% yield here. Moving on to the next one is USCL, the Global X Enhanced S&P 500 Covered Call ETF. This is super easy, everyone. It's literally the S&P 500 with covered calls, up to 50% of the portfolio. And by the way, Harvest typically does 30% of the portfolio, but at the money calls. So another, I failed to mention in the criteria, maybe I should mention it now. The Canadian fund managers typically never go over 50% coverage. So they don't do a lot of covered calls, which gives you that participation in bull markets as well. So they really have that good balance between income and growth, and that 25% leverage. Most of them have 25% leverage. One has 33, one has 20. We'll see in a second. But really, as you could see from what I showed you, and I'll show you a few total return comparisons, HYLD versus VSP, the total return comparisons where it's very obvious, right? You'll see that the performance is very, very similar to the underlying asset thanks to that 25% leverage. So USCL, everyone, S&P 500, very similar to HYLD, except it's literally the S&P 500. The yield is similar to HYLD as well, except this one is not hedged to the Canadian dollar. That is the key difference. I actually did a USCL versus HYLD video not too long ago, but the biggest difference is there is no, it says NA, but there's no currency hedging. So this one, the best benchmark is VFV, right? Because VFV is the Vanguard S&P 500 not hedged to the Canadian dollar. So if you do USCL versus VFV, since the beginning, it is underperforming VFV. But curiously enough for this one, and I'm not sure why, if we just changed the date, and by the way, USCL came out in mid 2023. So if you do the starting point, it's underperforming VFV. But if we just change it, if we just go starting January 1st, 2024, it's much closer. And at one point, it was even beating VFV during the height of the bull market last year or shortly a while ago. But as you could see, if you do the total return, for some reason, I don't know why, since the beginning of 2024 instead of starting in July of 2023, the performance is very, very similar, with dividends reinvested, with dividends not reinvested a little bit behind. But you could see how, both HYLD and USCL pretty much follow, everyone, the S&P 500. Okay, so that is number 2. And of course, for all of these, by the way, if you go on my channel, I have Q&As with with most of these. Search the stock symbol like USCL or HYLD and you'll see all the videos if you want to do some more deep dive research on them. But USCL is super easy, guys. Literally the S&P 500, not hedged in the Canadian dollars. Covered calls on max 50% of the portfolio, 25% leverage. And by the way, the management fee is the same as HYLD, 65 basis points. Before we continue, I want to take a moment to thank the sponsor of today's video. It's the biggest winner contest by Beta Pro, which is under Global X Canada. So in case you didn't sign up, you should sign up, everyone. It's really, really fun contest that starts September 15th and ends October 24th. So about 6 weeks. You could get, or you will get if you sign up. By the way, it's free to sign up and register. $100,000 in fantasy funds. And you could basically be a trader, a swing trader, whatever you want to do during those 6 weeks. It's really fun. You get $100,000 of fantasy funds. And if you have really, really good total returns, you could get real cash prizes, real money, right? So the grand prize after 6 weeks, 20 grand, runner up 10, third prize, 5,000. But every week there is a $1,000 rewards for in that week, whoever has the highest total return. They're even drawing $100 Amazon gift cards randomly as well. All the details are here. I'll put the link in the video description below. I highly recommend you register. Myself and Erica are registered. We will definitely enter the contest. That was really fun last year. It's going to be a blast this year where the prizes are even higher, much, much higher. So again, link in the video description below. I'll put it right at the top. Register. It's free, guys, and see if you're a good trader or not. Moving on to number 3, it's SDAY. So this is relatively new from Hamilton ETFs. It's one of the first, or the first, if they came out with the first 0 DTE covered call ETFs in Canada. So this is US equity BMAX ETF. So this one holds SMVP, which is an ETF that holds dividend aristocrats or dividend champions in the US. No covered calls. And then they have a portfolio. Here's the portfolio. And then they have 25% in VOO. So this is also 25% leverage. So you could basically see it as 80% of the portfolio is in the Hamilton Champions US Dividend ETF. If you want to look at the holdings, you look at it here, you could see what kind of stocks are in here. So the way I view this one, let me just finish on SDAY. And 20% of this, so 80% in that has no covered calls. It's just US dividend stocks. And then the other portion, 20%, is going to hold VOO. And that's where they're doing those daily covered calls on. So you could think of it as 80% of the portfolio, no covered calls, invested in blue chip quality dividend stocks. And the rest is in literally the S&P 500. And that's where they're doing their 0 DTE. So this one, if you look at the stocks, it's completely different. It's not the S&P 500. If you look at the breakdown, there's a lot more industrials and materials, consumer staples. So really the more boring value stocks like 3M, dividend champions, right? Coca-Cola, P&G, Caterpillar, McDonald's. So you have, the way I look at this one is more kind of like a Dow Jones type of index, but with the high yield thanks to those daily covered calls that they're doing on the S&P 500. So moving on, and by the way, they're in this particular order for a reason. So HYLD, just to sum up, kind of like it's basically S&P 500 or concentrated S&P 500, hedged to the Canadian dollar. USCL, literally the S&P 500, not hedged to the Canadian dollar. And SDAY, this is more like a, if you really like US dividend stocks that grow over time, this is more value stocks. That's how I see it. So these three together, guys, a good unit here to give you that broad-based blue chip large cap exposure to the US, right? Each are a little bit different. This one, the yield is really, really high, and it also has semi-monthly distribution. So 2 distributions a month. The yield is about 18% here, and only 20% of the portfolio has covered calls on it. That's because they're pretty much doing at-the-money calls on every day on the S&P 500. If you want to learn more, I have a long Q&A with Nick Picard, the guy who manages this ETF. Moving on, QQCL. This is literally like USCL, same exact strategy, same exact thing. The management fee is a little bit higher at 85 basis points, except instead of the S&P 500, it's on the NASDAQ 100 index. So a little bit more concentrated in technology. We know that There's a lot of overlap between the NASDAQ and the S&P 500, but because the NASDAQ 100 index is a little bit more volatile, you're going to get always a little bit more yield normally than USCL. So this is a great complement. If you like indexes, you like the NASDAQ 100 index, which is about 50% technology, this is a great one. I personally own this one as well. So actually, all of them so far, HYLD, USCL, SDAY, and QQCL, I own in my personal portfolio. So this is, if you like indexes, you like the NASDAQ 100 index, this is a great one to consider as a core position. Moving on to QDAY. So this one I was hesitating, should I add it or not? Because it's kind of like a pure technology play, and I don't want to have sector-specific funds in here, but technically, it kind of does the similar type of strategy that SDAY does, except instead of the majority of the portfolio in US dividend stocks, the majority of the portfolio, or 80% of the portfolio, is in the XLK ETF, which is a pure technology ETF. So it holds, the majority of it is Nvidia and Apple. And then instead of holding the S&P 500 or VOO, it owns the NASDAQ 100, QQQM. That's where they're writing their 0 DTE covered calls on. So I added it because technically there is the NASDAQ 100, so I guess you could say it's diversified, but this is very, 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 if not exclusively, technology stocks. I see it as a really good complement to QQCL, by the way, more concentrated in technology. But I had to include it because, it technically does hold the NASDAQ 100. So this one, the distribution, the yield's about 20%, also semi-monthly like SDAY. But again, because the NASDAQ is more volatile, you're going to get a little bit more yield. So this is about 20% yield. Moving on to HHIS. So you're kind of getting the theme here. Right now, we're really focusing on the US. So by the way, QDAY I own as well, and HHIS I own as well. So HHIS is the Harvest Diversified High Income Shares. It's an all-in-one ETF that holds 15 of Harvest single stock covered call ETFs. So you have here are the stocks, right? So this one is literally an investment in 15 companies, including the Magnificent Seven. You have Costco, Lilly, Strategy, Palantir. So the more innovation / hot stocks. I literally just did a full Q&A with Michael Kovacs talking about this. I highly recommend you check it out. So this one is it the highest? It is the highest yield out of all of the Great 15. So this has very high yield because, as we know, the yield when you're running a covered call strategy is based on volatility. So because they have the more volatile hot stocks in the US, they can generate more yield. So this is about 25% yield. The distributions have been steady at 25 cents a month. It's been out for 6 months now or something like that, a little bit more than 6 months. So the way I look at this one, by the way, is kind of like a concentrated NASDAQ 100. That's kind of how I look at it. It's 15 stocks, not 100. It's kind of similar to QDAY, but it's even more concentrated. It's only these 15 stocks. So you're really only investing in these 15 stocks right now with HHIS. Very, very popular. It's Harvest's fastest growing ETF, and it's awesome. I own it. It's just under 30% of my personal portfolio. All right, moving on to more North American global exposures here, because the last 1, 2, 3, 4, 5 really focuses on US equity, right? US stocks, big cap. HDIV, this is the ETF that started it all. It's the first ETF that came out, I believe, with covered call diversification and 25% leverage. Just like HYLD, it has transformed over the years. This is a little bit more concentrated in Canada. The track record is amazing. The performance is absolutely amazing. Here's the asset breakdown or the sector breakdown. You could see it looks a lot more Canadian, but it's actually about 62% Canadian and the rest in the US. And if you look at what it has a lot of the Canadian financials like HFIN and HMAX. Those are two of the top 3 positions. But you also have QMAX, which focuses on technology stocks in the US. You have EMAX, some energy, some gold producers. And it's not all covered call. You have HUTs and HFIN that are not covered call ETFs. So this one is extremely unique. You're looking at a yield that's always between 11 and 12, 12 and a half, something like that. They've never reduced their distribution. They've only ever increased it. Recently increased it to 17.3 cents a month. This is an absolutely phenomenal ETF if you kind of want mostly Canada, but also with the US. I think of it as, give me the best of Canada with the best of the US. What's the best of Canada? The financials. What's the best of the US? The technology, right? But there's also some healthcare as well, US healthcare with LMAX. Just a little bit, some real estate. So very, very well diversified. Very nice complement to HYLD. You know, Hamilton says HDIV and HYLD make a really, really nice complement. We'll look at the total returns in a second. Let's just move on. But this one is really phenomenal. I look at it as kind of a North America. Next, you have HDIF. Very similar. Came out at near the same time as HDIV. So this is Harvest's all-in-one. It is 100% equity, 100% stocks, and it's basically the best of Harvest. So they have Harvest ETFs in there, which tend to be more sector specific, but the combination is going to give you diversification. You have the global utilities and technology, brands, healthcare, US banks, Canada, a little bit of Canada as well, travel, low volatility Canada, industrial, REIT. So very, very diversified across the board. You have the sector allocation here with financials and technology and healthcare at the top. So this is Harvest all in one, just like HDIV, 65 basis point fee. Basically, because there's 0% management fee, it is subject to the underlying ETFs, which most of them are near the 65 basis point mark. So you could compare it to HDIV, but it's definitely more focused on US equities, where HDIV is a little bit more focused in Canada. Next one is from Global X, who are really the masters of indexes, EQCL. So this is literally the covered call version with 25% leverage of XEQT, VEQT, ZEQT, FEQT, etc., etc., etc. So this one, just like XEQT, give me the best stocks all around the world by giving me a combination of the best and most popular indexes all around the world. So this one holds the top indexes to give you stocks all around the world. So this has global diversification. Of course, at the top is the S&P 500. You have the NASDAQ 100. You have the Russell 2000 for your US exposure. You have the TSX 60 for your Canadian exposure. You have the MSCI EAFE for your Europe, Japan, Australia, etc. exposure. And then you have 10% in emerging markets. The total is 125 because it's leveraged. So here's the breakdown. Almost 50% in the US, 20% in Canada, and 33% in the rest of the world. So if you absolutely want global diversification, you like indexes, you love XEQT, you want to transition from XEQT to a covered call version, income version, EQCL is fantastic to consider, everyone. You're looking between 11 and 12% yield range. And by the way, forgot to mention, HDIF is typically in the 10 to 11% range. What is it? Where is it right now? It's 10.32. Moving on, BMAX. This is Brompton's all-in-one. So we're finally at some Brompton stuff here. So this one is pretty unique because it's one of the only ones, actually the only one on the list that has 33% leverage instead of 25, a little bit more. But it's also unique that it's a multi-asset, which means it's not 100% stocks. There is a little bit of fixed income in here. Personally, not my preference, but there's, you see the total here. There's about 12% in the preferred share, this ETF here, which holds US preferred shares. And there's also about 10% in the Brompton Split Core Preferred Share ETF. Stock symbol is SPLT, which holds the preferred shares of the split funds. Very, very, very safe and stable, boring 6% yield. So this one is definitely not the highest yielding one, but that goes for most of Brompton's products. But for like most of Brompton's product, they're very well thought out, and you're really looking at quality here. So you do have some global diversification here, right? You have technology, you have global infrastructure. These are all Brompton covered call ETFs. So this is a kind of like Brompton's all-in-one. North American Financial, Global Dividend, Europe. So this is really good if you want some Europe, some international, global, with a little bit of fixed income. So this is going to be, out of the Great 15, one of the more stable, less volatile ETFs, even though it has a little bit more leverage because it has some fixed income, because Brompton has chosen really some more safer sectors and a lot more dividend stocks. Like this one focuses on dividend stocks. This is infrastructure, right? North American financials. You even have a North American low volatility one, which has a lot of utilities, healthcare, consumer staples. So healthcare as well. So this is really one of the ones that's, you know, if you don't like too much volatility, you want global diversification, but you like nice 10% yield, this is a great one to consider, honestly. HBIE is if you really want a 60-40 split. Okay, so this is also covered calls. It's 25% leverage like HDIF. The main difference is that it's not 100% equity. So you guys know I'm personally not a fan of fixed income. That's why I don't own HBIE in my portfolio and BMAX as well. But if you absolutely still like the classic 60-40 split, so 60% stocks, 40% fixed income, this is like a covered call version of it. So even most of the fixed income assets have the covered calls on it as well. So if you absolutely want that's approximate 60-40 split with about 10% yield, monthly distributions, covered calls, 25% leverage, you have HBIE. Next one is new to, it's a fairly new ETF, but I have to include it because first of all, it's been doing really, really well return-wise, and it does meet the criteria. It's leveraged. It's diversified. So this is CLSA. This is Brompton's all-in-one, very unique, split share Class A ETF. So this holds multiple Class A shares of the many split funds that we have in Canada. You see the breakdown here. So most Quadravest still has the biggest chunk, so it has a lot of Quadravest, a lot of Brompton, and then the rest is middle field. You see the breakdown as well. Hopefully my face is not blocking anything, guys. But this one is really, really heavy on the financials, especially Canadian financials. You see Canadian life insurance is a big chunk, Canadian dividend equities, which there's financials in there. 23.2% is just North American financials, mostly Canadian, but some US ones as well. 20% in Canadian banks, a little bit in the global equities as well. So this is great if you love the split funds, but you don't want to miss the dividends. You don't like the missing dividends. You don't want to pick and choose your own split funds. This is a fantastic one to consider. So this is, with DFN at the top and LBS, the bigger the split fund is, the bigger the net asset value percentages here. So this is a really fantastic one. I look at this, if you really like the Canadian banks and financials, especially, this is a good one to consider. It's been doing so well that they recently raised their distribution. This one's a little bit higher yield than BMAX, a little bit. It's about 12% yield. It is new to the list, but I have utmost confidence in Brompton that they could sustain the distribution. I did a long Q&A with Chris Cullen talking about this one. I highly recommend you check it out if you're interested. Next one is GDV. So GDV and EIT are the two on the list that are not ETFs, but they're just so damn good I had to include them. So GDV is a split share fund from Brompton that's never ever missed a dividend. The total returns are absolutely phenomenally incredible. You have it here. Last 5 years, almost 20% average total return. Look at the 1 year. It's amazing. This holds global dividend stocks that grow their dividends over time globally, right? That's why it's called the global dividend growth. So quality blue chip dividend stocks all over the world that tend to grow their dividend over time. If you love dividend stocks, you want higher yield, looking for higher yield, and you want global exposure, this is a fantastic one to consider. It's actually trading at a discount right now. A lot of split funds are trading at a discount right now. That's why Class A is, this ETF here is really a good bet right now, by the way. But this one is probably, I have to say, my favorite split fund of all time. I used to own it. I don't own it anymore. Maybe I'll get back into it. I went with ETFs, but this is still phenomenal. ETF, everyone. The unit NAV is way above the $15 threshold. It's at 22 now. It's absolutely incredible. I don't think this is personal opinion here. I don't think this is ever going to miss a dividend. Lots of AUM. It's proven itself. And look at the portfolio. Quality dividend stocks here. Mostly in the US. So this is actually very heavy in the US. 70% US. That's where a lot of the best dividend stocks are. A little bit of Canada, Japan, and Europe as well. You have the breakdown here as well. Very, very well diversified in terms of sector as well. The highest in the financial. This one's really, really good, guys. If you like those more stable blue chip dividend stocks, great one to consider. EIT is another one that is And by the way, the management fee is 85 basis points, I believe, for this one. Is it 85? Where is it? I don't want to dwell too much, but I'm pretty sure it's 85, guys. EIT is like GDV is the second one on this list. That's not technically an ETF. It's a closed-end fund, but it's so freaking good I had to include it. So this is one of Canada's largest closed-end funds. We talked a lot about this on the channel. It's actually set up like a split fund. It has 2 preferred shares, and then you have the Class A shares, or the main ones, which is what we're talking about here. So the only issue is that it's actually very, very low yield because they haven't changed their monthly distribution at 10 cents, and the NAV has been going up and up and up. So if you buy it now, you're gonna get less than 8% yield. In terms of assets, quality blue chip, typically dividend stocks, low on technology. So this is another kind of value play, and it's mostly in Canada and the US. So kind of another North American, has a bit of international, but North American feel. I feel like if, let's say, someone owns a lot of EIT and they have a big capital gain and they want to increase their income, increase their yield, a lot of these ETFs are good to consider. But HDIV really comes to mind because the split really reminds me of EIT, mostly Canada, but US as well. So EIT is awesome. Total returns have been nothing short of phenomenal. You see here in the last 5 years, 10 years as well. This has been out for a long time. We're talking close to S&P 500 returns in 10 years here. So this fund is also very, very tax efficient. Management fees 1.1, but it's normal. It's higher, but hey, well deserved. Remember, total returns are net of fees, guys. So really solid choice to consider. Moving on is the Hamilton Enhanced Canadian Equity BMAX ETF. So same type of strategy of SDAY and QDAY, except it focuses on Canada. So it's SDAY's Canadian counterpart. So SDAY focuses on the US quality dividend stocks. CDAY focuses on Canadian quality dividend stocks. So it holds 80% of the portfolio is its CMVP, which are some of the top Canadian dividend stocks of all time. You're going to recognize a lot of the companies, guys, I'm sure, with a lot of Canadian financials here. I'm not sure why. There we go. Sorry about that. So these are blue chip Canadian dividend champion stocks, guys. Blue chip quality stocks that tend to grow their dividends over time. You get your typical Canadian breakdown, a lot of financials. You have the stocks here. You could go through them. And again, I've talked to Hamilton about this. So 80% of the portfolio holds CMVP, no covered calls, everyone. And the rest is in VU, which is how they're doing, or where they're doing their daily covered calls. And just like same distribution rate as SDAY, about 18% yield. Super genius fund, right? It's holding the Canadian stocks, but they're doing the covered calls in the US. That is just very, very smart. 18 cents, semi-monthly, so you get 2 distributions a month. So, this is, by the way, we're on to just Canada, by the way, right now, right? So US more, and then North American, international. Now we're focusing just on Canada. So you have CDAY part of that list, guys. This could be great in a non-registered if you want high yield, and you want a little bit of Canadian eligible dividends and capital gains and ROC and nothing else. This could be good in a cash account, very tax efficient, very high yield, focuses on Canadian dividend stocks, but writes those covered calls on the S&P 500 to give you that yield. Absolutely genius fund, everyone. Next one is HHIC, which is actually coming out, I believe, tomorrow. I'm filming this on August 20th, by the way. I don't know when the video is going to come out. HHIC is basically the Canadian type version of HHIS. It's going to hold, right now, 10 Canadian champion stocks. So, Royal Bank, TD, Enbridge, Canadian Natural, Cameco, Bell, TELUS, a couple of other ones. So think of this one, just like HHIS is a concentrated US, this is a concentrated Canada. So the first distribution hasn't been declared yet. My guess it's going to be 15, maybe a little bit higher yield. So this is really in the category of pure Canada. It could be a good complement to CDAY, right? You get your little bit more concentration, and CDAY's maybe a little bit more wide. So this could be a good complement if you want high yield, concentrated in those 10 stocks, which you could check out for yourself. But I just named maybe 7 or 8 of them, which I know by heart. But yeah, that is that it? We're at the end of the 15, guys. So I'm out of breath. Before we go through some honorable mentions, very important, right? Why is this one not here? Why is there's some diversified ones that I'll give you as honorable mentions, but I didn't include either because they don't have the leverage. That's most of the reason. There's so many in Canada. Again, everyone, it's really up to you which ones you choose, but this is my personal opinion, not financial advice. I think all 15 of these could be great core foundational positions in your portfolio. Whether you choose 5 of them, 1 of them, you just get all 15. It's up to you. There's no right or wrong. It's up to you to do the research. I have discussed these funds in depth with the fund managers. I highly recommend you search. Just go on my channel, hit the little magnifying glass and search the stock symbol, and you'll find all the videos related to it. But now let me give you my take on how I feel and how I see these real quick. And by the way, in terms of total return, yeah, I showed you the HYLD versus VSP, the USCL versus VFE. If we do the QQCL, I forgot to do it, but QQCL versus just the NASDAQ 100, you see how super close it is. It's actually with dividends reinvested as of 1st of January of 2024, QQCL is actually beating QQC. But without dividends reinvested, it is not. So let me just reiterate that I believe that this type of format fund, right? Not all of them have covered calls. The EIT doesn't, but most of them do. Covered calls and a bit of leverage, you'll get similar long-term performance as just holding the underlying, right? So like I showed you, HYLD will follow and perform very similar to VSP, USCL to VFV, right? So let me go through the list and just tell you real quick how I see this. So HYLD, I see it as an S&P 500, hedge the Canadian dollar, pure and simple. USCL, S&P 500, this is comparable to VFV. SDAY, more your dividend stocks, your value stocks in the US with covered calls. So I feel like HYLD, USCL, and SDAY, to me, I own all 3 of them, and to me, they're kind of like my S&P 500 unit. That's how I see them. And all 3 of them are a little bit different. So if you have HYLD and USCL, you mitigate the Canadian currency issue, the currency risk essentially, and SDAY gives you more of that concentration and more of the value stock. So sometimes when the S&P 500 is down, you'll see SDAY is up. I've seen that because, you know, these are dividend stocks which tend to be a little bit more stable and less volatile than the overall market, right? So these 3 are a great unit. QQCL, literally the NASDAQ 100, QDAY, concentrated technology, but it holds the NASDAQ 100, HHIS. These 3 I kind of see as a NASDAQ 100 unit, right? So these are the 6 that I own in my portfolio that make up the 6 core US positions, right? So I'm just telling you how I see them, guys. So HHIS is going to be more concentrated, QDAY more concentrated. Then you have the entire NASDAQ 100 index, which is about 50% stock. The next ones, HDIV, HDIF, EQCL, and BMAX. I think these could be compared to each other. If you want to compare the total returns, these are ones you could compare. They have a lot of similarities where it's like North America / global, you know, a little bit more outside the US. A lot of US in here, especially HDIV, but HDIF and EQCL and BMAX as well, and HDIV you have mostly Canadian. If we just do a total return comparison between these 4, it's quite clear that HDIV is beating everyone. It's doing really well. It's a top performer. So this is why I can't stop saying good things about HDIV. But these 4 are great to consider if you want North American international exposure, if you will. HBIE is the one that's on its own because it's a 60-40, right? So if you absolutely want the cover, if you absolutely want the 60-40, HBIE is for you. Class A, very easy, all-in-one split share fund solution. Absolutely genius idea by Brompton. If you like the split funds, you don't want to hold DFN and all the individual split funds anymore. This is a perfect thing to transition into. Very concentrated though in financials, in the Canadian financials. If you like global blue chip quality dividend stocks all over the world, and you don't mind the split fund structure, GDV is absolutely amazing. Great performance. EIT is just classic. Unfortunately, the yield is pretty low right now if you get into it, but I see this as a North American play as well, mostly. If you want Canada only, if you're looking at Canada only, would be CDAY and HHIC. CDAY, I really like the genius of, they're generating the income on the US market, which is the options is much more bigger and more liquid, but they're holding top quality, diversified Canadian stocks. So, even CDAY could even be a great complement to HDIV. And you could add HHIC if you really like those 10 stocks, really concentrated in the top stocks of each sector, right? Bell Telus, Royal Bank, TD Bank, Canadian Natural, Suncor, Enbridge, Cameco. You even have a uranium company there. You have a gold, Anico for the gold producer. And I think I'm missing one or two. But, HHIC, CDAY, HDIV could be a great kind of unit combo for mostly Canadian exposure as well. Let's go through some honorable mentions. And by the way, if you haven't done it yet, please hit that like button. I would really appreciate it. I'm literally killing myself going through this because it's so much to talk about. So many great funds. But there's plenty of honorable mentions. Again, I'm sticking with the diversified. So if you're saying, well, where's Bank? Where's QQQY? All great, amazing funds. There's a million sector-specific covered call funds in Canada. I'm not saying they're not good. I'm just focusing on the diversified ones here. So 9 Point, as well as Purpose, by the way, just like Harvest, they're all three of them are launching Canadian single stock covered call ETFs. And I'm mentioning 9 Point. I'm mentioning them as an honorable mention because, they're really new to the covered call game. They haven't proven themselves yet, but I could definitely see this one, if everything goes well, being part of the Great 16 next time. They actually have an all-in-one. Purpose is not doing an all-in-one as far as I know. But 9 Point is called ECHI. And it's going to have a lot of the same stocks that Harvest has, right? It's going to have a bunch of the covered call ones, Royal Bank. And I think it has 14 stocks. So this is definitely comparable to HHIC. Seems like the management fee is going to be a bit lower as well. But the 25% leverage, et cetera. So this is definitely an honorable mention, one to keep your eye on. Another honorable mention is CNCL. This is the TSX 60 with cover. It's basically, you got USCL, QQCL, CNCL as well. It's just, grade 15 is better than a grade 16, but this is definitely one you could consider if you absolutely want the TSX 60 index, diversified Canada. I look at it as the S&P 500 in Canada, if you will. And then there is a million non-leveraged ones to consider. Evolve has a great one for the TSX 60 as well, which is comparable to CNCL. I had to mention it because it's actually outperforming. Without the leverage, it's outperforming CNCL right now, which is pretty incredible. So if you absolutely don't want the leverage, everyone, there's a million funds to consider. ETSX, ESPX for your S&P 500. BMO, of course, has a million of them. ZWQT is their all-in-one. They have ZWG for global. They focus mostly on, they have some sectors now, but they focus a lot on dividend, cover calls on dividend stocks. There's JEPI, JEPQ in Canada, FEPI. There's a million more. So if ever you're interested, by the way, in following not only the grade 15 that we talked about, but also a lot of the diversified non-leveraged funds that could also be great core and foundational positions in your portfolio, please make sure you subscribe to the channel. Like the video, by the way. I think I mentioned that. Subscribe to the channel because I literally have a monthly series where I go over the entire high yield cover call ETF landscape in Canada and in the US. I'm on episode 64 right now. So the grade 15, all the ETFs we talked about, and a lot of the ones I didn't that are non-leveraged, I discuss and go over and review pretty much every single month in that video series. So make sure you're subscribed. So if you want to keep up to date, if there's any news, any changes, distribution increases, decreases, subscribe to the channel and follow that monthly series. So guys, that's it. I am out of breath. That is it for the grade 15. Hopefully you enjoyed the video. Let me know if you think I missed any. Again, I had a very specific criteria. And again, there's no right or wrong in investing. It's really up to you to figure out what are your core, what should what ETF should be part of your core or foundational positions, and which percentages as well. Don't forget, if you want some coaching, I do offer a one-on-one coaching service. Everything is in the video description below. Make sure to check it out. Details on our website, passiveincomeinvesting.ca. Watch that little video. We'll tell you all about the one-on-one coaching session, how to book a session. It sells out a lot. It sells out very, very quickly. I apologize. But, watch that video and you'll see how to book. So in case you need some coaching. So thanks for watching, everyone. Take care. See you next time.